Today I would like to discuss with you stock dividends journal entries. But before we jump into this harder topic, it is absolutely essential to review cash dividends as well as common stock issue journal entries. So let's take a look at your cash dividends journal entry. First of all, on the declaration date, what happens? You've got retained earnings credited for the amount of dividends that you are paying to your shareholders. You will be paying, I should say. And dividends payable, which is your current liability account, will be credited at the time. On the record date, there's nothing to record. Financial position has not changed, so accounting-wise, there's nothing to do. On the payment date, you will take your current liability account and will pay it off when you cut the checks to your shareholders. Let's take a look on the other side. You have common stock issue journal entry. How do we do that? Well, at the time we sell or issue common stock, you will debit your cash, you'll take number of shares at market value, and you will credit common stock, again, number of shares, but at par value. Naturally, you'll have a difference between the market and the par value. The difference, or the excess amount, will go into additional paid-in capital in excess of par right here. After this short review, we're ready to conquer the stock dividends journal entry. First of all, I want to bring your attention to the fact that I will cover only small stock dividends. What's that? It's the stock dividends that is under 20 to 25%. Percent of what? Well, if you remember, we have various stocks. And the first one, oops, I gotta change it to the pen. The first one, you will have shares authorized. That's the maximum amount that you can issue without asking for permission to issue more. The second one that fits right in is the shares that have been already issued. Now, if you have treasury stock, it's the stock that is held by the corporation itself, we cannot pay to ourselves or distribute the shares. Therefore, the only people or shareholders that will receive the dividends will be outstanding shares right here. So it's this part. So for example, if I were to have 100,000 shares of outstanding stock, I will multiply that amount by my stock dividend. Let's say I decided to distribute it 10% more. That will give me 10,000 more shares. That's the amount of shares that I will be using later on. Very similar to what you saw at the cash dividends, I will use the same account. All dividends will come out of retained earnings. Your textbook might be using either cash dividend account for your cash dividends, or they might be using stock dividend account. Both of those are temporary and they eventually close to retained earnings anyway. I therefore decided to go ahead and use retained earnings account right away. So we will go ahead and debit retained earnings for number of shares that we will distribute. For example, in our case, it will be 10,000. So number of shares that we calculated and multiplied by the market value of the stock at the time of the declaration. Now, what will be the credits? The credits will be a combination of these two. So please watch it. Very similar to your common stock issue, we will credit a brand new account, common stock dividends, but not payable like you saw in the dividends, but distributable. What does that mean? What kind of account is that? It's your normal contra equity account, ALCA common stock to be. It is presented in the equity section of the balance sheet right after your regular common stock account. sort of a sub until we actually distribute the common shares later on. At what value? Very similar as to the common stock issue, you will take number of shares and record them at par. Record them at par. You will have the difference the same way as you had the difference between the market and the par. There will be difference between the market and the par value. In the same way, you will use your additional paid in capital account from common stock in excess of par. So number of shares at amount that is over par. Over par. Okay, here comes the record date. Very similar to your cash dividends, there's no journal entry. I don't have to worry about it, anything like that. Here, no journal entry. On the distribution date, what do we do there? On the distribution date, I will go ahead and give them these stocks as stocks certificates. So I will go ahead and debit common stock dividend distributable mouthful account for the same amount, that's your par, and identical 100% to your common stock issue. I will give you common stock, and it will be number of shares at par. Okay, it's very hard to write on the iPad, therefore I went ahead and gave you the actual presentation of these. What will it look like for you? It should look just like that. So ponder looking at these, compare your cash dividends, common stock, and then stock dividends, and see if you find common trends. That's the key. Keep it simple.